Welcome back, traders. I'm glad to have you here today. The next long-term chart pattern on our list is the triple bottoms chart pattern. The triple bottom pattern is a reversal pattern formed after an extended bearish price movement resulting in 3 swing lows. The triple bottom pattern technically supports bullish anticipation. The triple bottoms can result from the failure of the confirmation of the double bottom chart pattern in the market. I will show you the 2 ways to apply the triple bottom chart pattern in the market. First, I will show you how to apply it in an uptrend as a continuation buy trading strategy. After you are familiar with the continuation trading strategy, then we will proceed to the reversal trading strategy from a downtrend into a bullish trend. Here comes a triple bottom after a bearish swing on the chart of the Euro-Japanese yen. Let's zoom out to see the direction of the major trend in this market. As we can see, this market was in a bullish trend. Let's analyze the position of the formation of this chart pattern in this market with the aid of the Fibonacci tool. Apply the Fibonacci tool from the last higher-low swing here to the peak swing here. Now let's zoom in to see the reaction of the Fibonacci retracement level on the trading chart. As we can see, the triple bottoms formed at the level of the 61.8% Fibonacci retracement level. Now let's study the psychological analysis behind the formation of this triple bottom in this bearish pullback. After the bears pulled down the price to this support structure, the aggressive bearish sentiment dried up and the bulls set in. The bulls failed to extend the price upward at the first bull swing here, and the bears set in again. Price bounced up again from the first low swing here, and the bulls projected another bullish swing. Impatient traders could have bought this bullish candlestick here in expectation that there would be a double bottom formation. Unfortunately, there was no upward penetration of the double bottom's neckline. We can see how the bears set in once again to pull down the price. Smart traders saw this price action as an opportunity to watch out for scalping trade setups at the upper and lower structures of this ranging medium. After the bearish price hit the support structure at the $137 price level zone, the bold traders executed a buy setup to scalp within the upper and lower bands in this market. Long-term traders saw this as an opportunity to accumulate more buy positions. After price hit the upper minor resistance structure once again, some short-term bullish traders attempted to sell from the $139 price level. Suddenly, there was a higher buy order that superseded the selling order at this level. The aggressive traders executed a buy position from the first bullish breakout candlestick above the neckline of this triple bottom. Remember, it's not necessary to wait for the retest of a chart pattern if it technically supports the continuation of an existing rally in the market. Although this wasn't a strong bullish candlestick, conservative traders would have preferred to wait for more confirmation before concluding this as a reliable triple bottom for the continuation of the previous bull trend in this market. We can see the bullish breakout bar has an upper shadow and this suggested bearish interest is not totally exhausted. This resulted in a consolidation phase within this medium. The formation of a pin bar candlestick here gave the retest of the neckline of this triple bottom pattern. The next bullish candlestick after the pin bar gave the entry confirmation level. Stop loss is best suitable at the low of the third bottom here. We can see how the trend extended upward. Now let us proceed to the triple bottom pattern for the reversal of a downtrend into an uptrend. As we can see in this aggressive bearish rally, after the price plunged to the swing low at $1.24 price level, the bears were unable to move the price lower from this price level. After price carved the second bottom structure here, we can see there was volatility in the market at the false bullish breakout of the neckline structures here. The market later retested the same low level for the third time. Price transited upward, and this resulted in a triple bottom chart pattern. And again, aggressive traders who wanted to buy this third breakout of this triple bottom were bullish trapped. The conservative traders who waited for a retest and a decisive bullish breakout could have bought this setup after the close of this strong bullish candlestick above the neckline of this triple bottom here. There are two ways to apply stop loss in this triple bottom buy setup here. Stop loss option 1. Day traders can place their stop loss below the swing higher low that led to the bullish close of the candlestick above the neckline structure here. Day traders could have profited from 2.7 risk to reward ratio in this buy setup if they were to target the minor resistance level here at $1.27. The second safest stop loss level, especially for swing traders, is at the low of the third bottom swing at the $1.24 price level. Swing traders could have profited from 1.5 risk to reward ratios in this triple bottom buy setup if they were to target the minor key level at $1.27. The extra conservative traders who were not convinced of the bullish breakout here would have decided to buy at the second retest here. I'm sure that the patient traders who waited for the retest for a buy entry here will not have difficulty to patiently ride this trend in this strong bullish rally. This is a massive 6 risk to reward ratio. Now you can see that the financial market is a medium to get money away from impatient hands into the pocket of patient investors.